All right, everybody, good morning. I hope you are doing very well. Happy Friday. Not sure how long I'll talk with this one. I have my 10th cold virus of the winter. The joys of preschool and kindergarten with a daughter. Wouldn't trade it for anything, though. So, anyway, going to try to do an update here on the United States money supply, and we will tack on Bitcoin as well for some fun to see how Bitcoin has accreted in value versus the main money supply in the world. That is, of course, the dollar. And there are many different money supplies. So that's what I'm going to talk about today. I haven't updated this one in a while. There's a full stack of the United States money supply. I'll repeat a couple things. Let's take off M3. Let's just go from M2. Okay. So this is as of December. And unfortunately, with this one, it moves very slow. I only recently updated it because the Federal Reserve only recently updated some of their exhibits where they only anymore publish quarterly data. Some of the money supplies are monthly, M1 and M2. Although M1, as I've said many times since the 2020 pandemic, has just been a complete basket case of information. They've changed the law in the United States to where basically savings deposits are treated the exact same as demand deposits, and therefore they're like, oh, well, let's just basically make M1 look like M2. So you get, this is a, if you look at the M1 here, let me take off everything so you can be very clear what I'm talking about. You look at the 1 and the 2, all right? This is M1. This is the most public-facing money supply, M1. You see that it definitely jumps up during COVID, but if you look at a chart on the Federal Reserve's website, it's jumping up almost to the level of M2. And people think, oh, look at all that money printing. No, they just redefined it. Unbelievably stupid for a central bank to even, try to put these money supplies in ways that are confusing and not backwards compatible. So it's just unbelievable. But here is my M1 is backwards compatible. It's not going to be exactly calculated the way that M1 was calculated before COVID. It's still pretty good nonetheless. What is M1? All right, now look at, we have M1 and M2. All right, M1 is the 1. The darkest green money supply here. What does M1 mean? It simply means currency in circulation, that is cash printed by the Fed, by the central bank, plus demand deposits. Demand deposits typically being the most liquid of all commercial bank deposits. As I said, they've changed the definition. Don't worry about it. This is pretty close to backwards compatible. You see a huge boom or money print during the 2021 2020 to 2021 scare. So we were at somewhere, look, I'm looking at M1 in the tooltip now. We're at $5 trillion in M1. Went up to nearly 10, pretty much doubled in a year, over a year, a little over a year, 18 months, something like that. All right, M2 is M1, but it's some more stuff. Okay, so this also includes less liquid retail type deposits. Okay, so time deposits are included in here, and also retail money market funds. Now, a retail money market fund, just think of it like a stable coin basically, for retail, not for institutional, but for retail. That's included in M2. And, along with time deposits, basically this money's locked up in a different way. Of course, with money market funds, when would someone hold that? That's if you sell out of stocks in your brokerage account and you hold cash. That cash is a money market fund. It's an instrument that's pegged to the dollar like a stable coin, but it is not the dollar. It is not a dollar-based deposit like the stuff that is in M1. So that's why it's a less liquid instrument, even though you would think a money market fund is very liquid, and it is. I mean, it's traded all the time, every night. Money market funds can even go into repos, which is a whole different thing, and that's in a different money supply. But the point is that it's not, when you have a money market fund or a time deposit, it's clear that you can't at least immediately withdraw that cash out of an ATM, for example, or you can't go to the bank immediately and withdraw it for cash. Okay, so that's M2. And M2, like M1, but mostly because of M1, had another boom in money print during the COVID times. You see 2020 here, February 2020, M2 was 15.4 trillion. And by May 2022, all right, so, 2 full years in this case here, 21.5 trillion. All right, so a doubling in basically 18 months to 2 years. That's what happened. Now you see that it's leveled off a little bit, but creeping back up, both of them. This goes in line with what you've heard from the Jackson Hole speech a couple years ago from Powell, saying that basically he's going to ease off on the liquidity from COVID. This was from 2023, the Jackson Hole speech. No, maybe even 2022, when you see that it's summer, late summer 2022, saying that they're going to ease off the gas. And you can see that here. In fact, they did. But another thing to understand is these are commercial bank money supplies. So the Fed does not directly control these, okay? It's certainly regulated entities that are involved in these money supplies, primarily commercial banks, primarily credit unions as well. But it is not the Fed itself. The Fed itself controls what's called the monetary base, and that's here, M0. Okay, so M0 is a part of M1 and M2. This is public-facing cash in grocery store tills and other shopping centers and department stores and all around, and in people's safes at their home. Okay, all the cash printed from the Federal Reserve throughout all time in the last 100 years. 2.3 trillion, you see, as the amount here as of December 2024. But Federal Reserve money, central bank money, also includes this thing that I talk about all the time, which is reserves, or basically the cash account for those commercial banks. And that's here. Okay. Let me zoom in to make this a little bit easier to understand. So I have it as a negative because it is an asset for the banks. Okay, but we don't really have access to it. So this black rapidly increasing post GFC line is bank reserves and vault cash. And you see that instrument, the reserves basically, and vault cash, which is a very small proportion, right? When you want to go to the bank and actually take money out, there's a little bit of cash there. That's 4 trillion in 2021. Let's go 2022, coming down a little bit actually. But of course, there's another instrument here, the repo instrument, which made this central bank money even bigger, but it's not technically central bank money. I'll talk about it in a second. That was even more. Anyway, so if you add the black instruments up, M0, which is just cash in circulation, and the bank reserves, which is basically just every bank's account with the Federal Reserve, at this point here in December 2022, you had a $5.4 trillion monetary base. Okay, and this is the United States only, United States money supply only. And you see, it's been somewhat stable in the last couple of years. And this indeed has to do with the Jackson Hole speech, 2022, it would be, when they said, finally we're easing off the gas from all this COVID money printing. Okay. Now, A lot of times on Twitter, people that grab charts that are easily available, they'll stop here with the United States money supply. Why do they stop here? First of all, they don't show you how this actually fits all together. And again, you have to put the bank reserves as a negative because it's inside the banking system as an asset for the banks, but we don't get access to that money, so it's different. When cash is out in the system floating around, that's an asset for us. So if we can actually hold some foldable money in our wallet, actually have foldable cash, that's an asset for us. As well as if we have a bank account with those same banks that have reserves with the Federal Reserve, that is also an asset for us. Okay, so what you see in green and the zero is assets for us in the economy, in the banking system. All right. So M0 plus M1 plus M2 is all the public-facing money. And if you add all that together, you get 21.2 trillion as of December 2024. But again, the mistake that people make is they don't think about M3. If you want to talk about total liquidity, total monetary liquidity in the United States, you got to at least get something close to what the Fed was publishing as M3 before. Now, why do I say was? Because in 2006, they stopped publishing M3. This is the old M3 money supply. They stopped publishing it in February 2006, $10.3 trillion at the time. It's curious that they stopped publishing at the time because this was only 2 years before the global financial crisis. And they made it seem in their statement it wasn't a valuable money supply to keep publishing. What we learned later, based on the data that had to be published because of Dodd-Frank and some of the overhauls that were done on the Federal Reserve's transparency post-GFC, we saw that they were already losing control of this money supply. Okay, so how can I show that? Well, I can add on more exhibits. And again, this is like a puzzle. You can't find this very easily on the Federal Reserve's website, but I've broken it down for you, and I'm going to continue breaking it down for you. Now let's move up to the real M3 money, which if you want to get to system-wide liquidity, that's that. So now, remember how I said M2, all right, the 2 in this chart here includes all the retail money plus less liquid retail money. All right, so not just bank deposits, but savings deposits, time deposits, retail money market funds. Well, notice I didn't say institutional. I didn't say commercial accounts. All of that is in M3. It's in M3. So now I'm going to draw it here. All right. And I've broken M3 into a couple different tranches. We're going to look at the first tranche. This is M3 you see in the tooltip. It says X Eurodollars and repos. Okay, so it's not including Eurodollars, which I'll explain, and it's not including repos, which I'll explain. What does it include? This M3 money includes institutional time deposits and institutional money market funds. And again, a money market fund, don't get confused about it. It's just a stable coin in the traditional financial system. Okay, you're giving a non-bank entity like a broker or a hedge fund your cash as you trade out of a stock. And therefore you have this receivable, an asset for you as and this is on the institutional level, the pension fund level, with another entity, typically a broker-dealer, but a non-FDIC insured entity. Okay, so that money is here. So again, you can define this different ways. I like to say less liquid. That it has been defined before with these broader money supplies. Of course, they are liquid in that they can trade fast, but you can't immediately go into cash. You can't immediately go into foldable money. That's the point. All right. Now, notice here, from mid-2023, when the other money supplies were going down or flat, what's happening here with the M3? It's actually going up. It's going up. Okay. Let's look before the GFC. What was happening with the M3 money? relative to M2. It was going up. There's a delta increasing. Okay, you can just see it with your eyes. By March 2008, it was 12.2 trillion. M2 is 7 trillion. So the delta there's about $4.5 trillion. And if you go back just to when the Fed stopped publishing their M3, the delta between M2 and M3 was, in my example, in my money supply, forget the Feds for a second, 3 trillion. Even less than 3 trillion, 2.5 trillion. So there's a spread of about $2 trillion that came into M3 in the span of a couple years. Coincidentally, right at the time that the Federal Reserve stopped publishing M3 in 2006. And then we can get to the next tranche of M3, which, you have to just go through the quarterly reports of the Federal Reserve to find this. That is repurchase agreements. I was reminded to give you guys this update based on the podcast I did with my buddy Marty on TFGC last week. This is a huge bucket of liquidity that's in repurchase agreements, okay? And what repurchase agreements are is basically you have all these money market funds. You have cash sloshing around between hedge funds and money market funds and pension funds. Large institutions, when they want to get out of stocks, get out of securities, they want to get into cash, they want to hold money market funds. But they can also offer a deal to money market funds and say, look, we have this security. We'll pay you a little bit higher interest than you, Mr. Money Market Fund, is getting from the Treasury itself. So let's wrap up my security. I'll pledge it with you. You give me a little bit more of that money market fund liquidity, and I'll pay you a higher interest rate typically than the United States Treasury itself. That's a repurchase agreement. It's levering up to do more. It's just leverage. All of this is leverage, right? M1 is leverage, M2, M3. Repurchase is another form of direct leverage, typically involving U.S. Treasuries. So let's draw that next tranche. And this is still in the old classical M3, repurchase agreements, large or institutional time deposits, and institutional money market funds. I'm going to draw on M3 with repurchase agreements now. Okay. See, it's going up even more. And that total right now, as of December 2024, again, this is a slow-moving oil tanker money supply, $35 trillion, $35.4 trillion. The peak before the GFC, you can see it peaked here in March of 2008. And this is data we could only know later because the Federal Reserve wasn't publishing it, 16.5 trillion. Let's go back to when the Federal Reserve stopped publishing itself. You'll notice my M3 with repos is higher than the Federal Reserve's M3 when they stopped publishing. Why? The reason is, as I told you, the Federal Reserve was losing control of the repurchase agreement market and another component, which is Eurodollars. And I'm not even including Eurodollars in my M3. In my number 3 there, the 12.46 trillion, as you see, which is already 2.2 trillion over the Federal Reserve's number. In this particular case, the Federal Reserve was only counting repurchase agreements from banks, but they were not counting them from the shadow bank industry. All right, the shadow bank industry was running wild at this time with mortgage-backed securities, levering up bad debt on treasury securities, mortgage-backed securities. And then you would get this phenomenon where Norwegian pension funds were buying it. And we're going worldwide with this sort of, it's just simply levered up money. Okay, you can call it less liquid money. It's not dollars that you can, like I said, eventually fold and take out of a bank account. It's just a ledger entry. And it was based on bad underwriting. But notice what happened here with the money supply before GFC. Specifically, let me take off now my first tranche of M3 so we can see it better. Look at this. With my revised money supply, and by the way, the only way I could get this data is the Federal Reserve, like I said, because of Dodd-Frank and other things, somewhere here, 2014, 2015, started publishing better data even back into the past. But differently, quarterly, it wasn't as good. They didn't even for a stretch here publish the central bank, or not, excuse me, the central bank, the commercial bank repurchase account. So you have to regress and do all these things. But anyway, you can see that I'm basically putting the puzzle pieces together and it looks relatively cohesive, let's say. But look what happened. And by the way, original people that I'm following for ideas here, this is my calculations going back with everything with the Fed, but someone like John Williams, who I don't think publishes anymore from the website Shadow Stats, you can find he was doing an M3 analysis back in this time. But this isn't even all of M3, which I'll get to in a second. But look, you can clearly see leading up to the GFC, something was happening. And it was not in the central bank's books. Look at the central bank. Let's take off everything. Just central bank money looks pretty normal. I mean, it's growing, but the reserves are just super small. 100 billion here, there. That's for the whole U.S. banking system, 100 billion. And the cash, 800 billion. This is a full look now, a zoomed in look at the Fed's money. Let's just put back the total M3 to give you the full effect, and M2, so we can see the delta here. Really, the delta was in M3 money. Okay, it was institutions playing hard and fast with securities they didn't understand and they didn't underwrite properly. They eventually got bailed out. All right, and those securities went onto the Federal Reserve's balance sheet, as you see here, the black craziness. All right, but the money supply itself, the warning sign was in M3 before the crisis. It was not, had nothing to do, you can't tell anything with the Federal Reserve's balance sheet. This is why it's more complicated than just saying all the Fed does is print money. Yeah, they do, and I'm not defending them, but it's more complicated in the world of money and banking. Hi, Kevin. Good morning. Good morning from the Baltics. Really early morning for you from Florida. Thank you for writing in and watching. So I've said this many times before. Look, I mean, the warning sign was here. It's hard to know when that peak was, but interestingly, before the GFC, and remember, Bear Stearns happened here in 2007. Same deal, bad debt, liquidated. We do flatten out with this M3 money supply before fall of 2008. But clearly, you can see that the delta between M3 and M2 is increasing. The delta here, let's say if this is the peak, 16.5 versus M2, 7.5 roughly, let's just say. So 9 trillion would be the delta there. 9 plus 7 is 16, roughly, all right, in M3 money. Whereas if you go back to where the Federal Reserve stopped publishing their incomplete money supply, the delta was 6. And then if you go back a couple years before that, I'm looking between my M3 and my M2, the delta was 4. All right, but it took time, all right? It took time, but this is what the global financial crisis led up to. And then interesting, look, M3 here, because all of that liquidity went into the Federal Reserve's balance sheet, you see the bulge in the black underneath. All right, after the bailouts, M3 money kind of interestingly stayed the same for the last 15 years leading up to COVID. And then even here, the delta is the same. The increase and why we had a lot of price inflation from COVID was the delta was not in M3 money, it was in M2 money. Remember, M2 money is more retail money. M3 is institutional. But now, here we go. We're getting more of a spread in M3. And one more thing, which I haven't showed, is there is more money that the Federal Reserve held M3 money post-COVID as well. And that was here. Unfortunately, I have so many. Yeah, it's a little bit better. My zoom gets a little bit out of whack with so many different layers here, but the delta was sort of constrained around this time in 2022 because the Federal Reserve opened up a lot of liquidity for these non-banks, money market funds. So look, buy our, we'll pay you a higher interest rate than we're getting on the Treasury. That's what the Federal Reserve says. Take our Treasuries. We'll lend you, we'll borrow from you, collateralize them, pay you a higher interest rate than the Treasury. So the money market funds say, yeah, sure, great. So the money market fund's asset is somewhat stable around this time. It's not like really increasing versus the rest of the system. It is a little bit because you see M2 going down. But the Federal Reserve's liabilities, this is a liability for the Fed, that's why it's a negative in this chart, goes up. And you see that there's that delta. I'm now looking at that on the tooltip with Fed repos and just the bank reserves and cash. That liability gets over $2.5 trillion. All right, that was a huge pile of liquidity that the Fed took away from the system, but also took competitiveness away from the system because money market funds and everybody was scared. They said, we'll take it away. And now what's happening? They're putting it back in. They're putting it back in the system. So as you see this, I'm looking at the little bank icon, all right, with Fed repos. It's a full Federal Reserve balance sheet almost. It's leaving the Fed, that liquidity, and it's going back into the system. And what's happening to M3? It's growing proportionally, correspondingly. Correspondingly is the better way to say it. All right. And what we happen to see there is you see this delta increasing. M3 versus M2 is increasing. So I'm not predicting a financial crisis around the corner. I mean, everybody does that every week. But if you want to look at hard data, we're increasing here. And at the time, this data was not available. So it's another thing. At the time, it wasn't available. And, let's zoom in and then zoom out. Unfortunately, my zooms get messed up. Sorry. There we go. We didn't really have this signal pre-GFC. You had to look at other things, but you can see it clearly now that it kind of pops. It pops before the official GFC starts. Will we see a similar thing? Will we see this sort of deflate? People give up on all this excess liquidity? I don't know. But you are seeing a delta there. So that is an update on the United States money supply. This is different than the monetary base globally, which I publish and I talked about yesterday and often. It's just the U.S. Now, let's bring it back to Bitcoin. Let's take off M2. Let's take off the Fed repos because it's kind of just confusing. These are the numbers. Oh, and one more thing, by the way, before we bring it to Bitcoin. You see how my M3 in the tooltip says X Eurodollars, not including Eurodollars? That's another bucket that was in this M3, but again, the Federal Reserve stopped publishing. So 2 clues of why the Federal Reserve stopped publishing M3. The first clue is repurchase agreements, which we just talked about. They lost control, and you can see that in hindsight, they lost control. They realized they weren't counting them all up appropriately, all right? And the second is Eurodollars. Now, Eurodollars, I do not yet have a proxy on how to figure out how to give you a nice chart like this. It could be huge. It could be huge. Eurodollars are like, in some way, they're like a stable coin again, but it's a stable coin that's sitting in banks all around the world that the Federal Reserve doesn't control. It's offshore dollars. That's a Eurodollar. It's the name of it. It goes back to the days of World War II and post-World War II, and European nations just wanted dollars. They didn't want to even hold, Deutschmarks or whatever. They'd rather have dollars. So you had offshore dollars sloshing around different banks around the world. And this is outside the control of the Federal Reserve, even at that time. But they still tried to measure it. And it wasn't much. I mean, you can see here, again, my tomato line, the M3 that I stopped publishing, and they stopped publishing in 2006, includes some Eurodollars. I don't remember the exact amounts. Of course, at the time, it's like under $1 trillion. Now, if you look at this line, my M3 without Eurodollars, we're at $35.5 trillion. It could be trillions. I mean, it could be tens of trillions in Eurodollars. No one exactly knows. You could use proxies like the Panama Papers, the Paradise Papers, all of these leaks. Some of those are Eurodollars, not all, but if they're dollar-based accounts in the Caribbean or in Isle of Man or Jersey or Guernsey, those are Eurodollars, and they're probably huge. So that's dollar liquidity that's not counted up or regulated by the Fed. It's another asterisk to how difficult this can be to actually try to chart it out. But nonetheless, this is in my opinion a pretty good M3, pretty good representation of total dollar liquidity, except for those Eurodollars. All right, more complete than the Federal Reserve ever did it, and it's 35.5 trillion. Now, what is Bitcoin comparable to? I've been saying this for 7 years now. It's not the number 3. As much as people would like to think about that Bitcoin's going to take over the number 3, I don't see that happening anytime soon, and the charts don't say that this is happening anytime soon. But also, if you just understand how balance sheets work, it's not happening anytime soon. The comparable fiat money supply is in the black, the gray and the black. That's the monetary base. Okay, because the Federal Reserve's money supply that they control directly is the zero and the safe. Right? The zero is the actual cash that's outside of all banks and outside of bank vaults. And what's in the bank vault, plus the reserves, the bank account with the Federal Reserve, all banks like JP Morgan, Bank of America, Wells Fargo, they each have one master account with the Federal Reserve. That's the bank reserve account. That's Federal Reserve liquidity. That's central bank money. That's the black line. And you see that, of course, this is bailout money. This took away a lot of that M3 money, put it down in the Federal Reserve to bail them out post-GFC. Anyway, the total at the moment, about $5.5 trillion as of year-end 2024. That's the most analogous money supply to Bitcoin. Now, I showed you yesterday the total monetary base. I calculate that too, looking at pounds and yen and yuan. That's 25 trillion. Okay, so that's still a big number. But if we took this M3 and extrapolated it globally, it would be over 100 trillion. All right, so we get this famous or catchy $100 trillion number. But I hasten to say Bitcoin it's just not comparable. It's not comparable to this money. These are just claims by institutions on each other and on individuals. Eventually, all of these claims go back to the Federal Reserve. Eventually. But it takes time. It's staggered. There's really no start date, no end date. It's just an amorphous blob of claims. The actual money that compares to Bitcoin, compares to UTXOs, compares to the market cap of Bitcoin, which is a little under 2 trillion at the moment, it's in the black and the gray. So, let's run the comparison, finally. After all that explanation and update on total money supply for the US, let's look at the percentage of Bitcoin versus the base. So I'll take off M3 to not confuse anymore. This is the base money of the United States. Gray is public facing, black is only for banks. Still, you add them up to understand the total liquidity. BTC, market cap as a proportion of. There you go. Looks very similar as price. Looks very similar as price. Almost the same as a price curve, right? I'll put it in log scale in a second, but I'm not going to do it at the moment because my charts can't handle it. But we see 2021 top Bitcoin was 18% of $5.8 trillion, right? 18% of the United States monetary base, and now 33%. Down a little bit because Bitcoin was rocking over the holidays. Now it's pulled back. Around 80 now. I haven't actually checked this morning. Whatever it is, 80K. Still, you get the idea. This is the trend. It's pretty wild that again, this is apples to apples money. So at least for, Bitcoin, I understand we're comparing a global money, Bitcoin, versus United States money. All right. And even though don't get confused, even though they say the dollar is the world's reserve currency, it's still controlled and issued by one central bank. So this is United States money. All right. We'll talk about Eurodollars again another time. Good morning from Italy as well. Venom, thank you for the message. Just talking a little Bitcoin versus United States money. So it is pretty wild to think that 30 cents of every dollar printed by the Federal Reserve has now, Bitcoin has accreted to that value in market caps. Pretty wild. That's a wild thing to think about. Again, if you remember yesterday, I did Bitcoin versus total base money. You're only getting to 7 or 8%, but still, just looking versus the United States dollar is pretty interesting. And then let's reset the zoom now, and let's put all the money supplies back. Okay, it's the whole United States money supply. Gotta go back, zoom out. Why? There we go. Better view here. All the way up to that M3 money. All right, 35.4 trillion. Just to see what is the market cap of Bitcoin versus M3. Much smaller. 5.2%. 5.2%. But again, this 5.2% is not, it's not really worthwhile to look at. You can do it. Anybody can do it all the time and measure, but it's really not what Bitcoin is comparable to. And in fact, if you think about what this M3 money, all these shades of green, again, these are just claims created by different institutions against other institutions, other individuals. Simple sum claim of all those claims. If we wanted to make a apples to apples comparison of the Bitcoin world, we would need to include other things like open interest on futures, or everybody's exchange account holding Bitcoin. What is the Bitcoin value of everybody's exchange account? Okay, because that itself is a deposit. When you log on to Kraken, you log on to Coinbase, you see Bitcoins on your dashboard. You don't control the keys. You have a claim. It's M1 money for Bitcoin, what I'm showing right here. So if you really wanted to be technical and fancy, and maybe eventually the data will come, you'd add all the claims in Bitcoin world on Bitcoin, all right, and then add that on top of the UTXOs in dollar terms. That's just how you would do it. And make no mistake, it's coming. We have plenty of companies that are collateralizing Bitcoins, making loans. You got Debify, who has been sponsoring the show, by the way. I need their logo when I do live streams, but on the regular videos, you see them. Other companies that are all collateralizing UTXOs, making loans. It's the same thing that happens in this system. I'm not saying it's right or wrong. I'm not saying you can regulate it properly. It's just the world of banking. Is you have people that you trust, and maybe even people that you don't trust, you make contracts with, and the money supply increases. That's how it works. So the point is, this smaller orange line, it's just not much info, in my opinion. A more interesting is the bigger, because that's a percentage of what apples to apples really Bitcoin is, which is not any of these other money supplies. It's not the green at all. It's a percentage of the black, the shaded areas. Whoops, sorry. It's actually this. It's a percentage of that. So 33%. And then if I put them all back on, I can go log scale just to show you. Let's go log scale on the right axis now. And what do we see there? Let me take off these. Let me go back to the Bitcoin chart. Here's a linear scale of the power trend line. But if I go log scale, you get that nice, gentle power curve. Okay, Bitcoin's a power curve. What do you see here? There's a power curve. I'm not drawing trend lines through it in this exhibit, but clearly, it starts off pretty fast. It's a gentle asymptote as we continue on. These are power curves. So even, as I said yesterday, even when you have power curves multiplied or compared against exponential curves, which is all these money supplies, I could take M3, M0, the monetary base, doesn't matter. I could run trend lines. They would all be straight lines on log scale. Okay? Let's put the left on log. Not sure how this will look, actually. Yeah. You can't do negative logs, so it takes away the other one. But on log scale, any stock, bond, money supply, GDP, population is going to turn into a straight line, the trend line on log scale. And you see that's happening here. So when you compare the exponential trend, which is a straight line, the green money supplies, versus Bitcoin, which is a power relationship, the default or the result is power. Bitcoin shows you that power dominates all relationships. It's still a power curve. It just shows you how incredibly strong the power curve is. Let's take off the M3. This is the real relationship. I even lost my repos because of that log move. Figure it later. Anyway, this is the relationship. Bitcoin versus the monetary base is in that orange line. $1 in $3 is captured by Bitcoin at the moment, only looking at that direct relationship, ignoring all of the currencies. It's pretty wild. And it's on a trend. That is a trend. Peter Schiff cannot talk you out of that trend. No one at the Federal Reserve can talk you out of that trend. This is worldwide, global, final settlement base money, UTXO money. And it is now 1/3 the value of the United States monetary base. That's what I wanted to show you. And that has nothing to do with these. It only has to do with this. And I'm going to have to reset the chart, unfortunately, because I'll reset it just to deal with this video. It's stream, unfortunately. Close it out with this. Let me know if you guys have any questions, because it's pretty much how I wanted to close it. We take off all of the other things. At the end of the day, the central bank money. What's going on here? All right. This is what's really happening. Bitcoin, you can always compare it to these broad money supplies, but this is just different stuff. It's liabilities traded with other entities trying to trade other liabilities and so on and so forth. The base money is here, and that's what a UTXO is comparable to. We got $5 trillion in the system of the United States. Bitcoin is 1/3 of that. That is the apples to apples comparison. Got a question here. What do you foresee happening in the next months in terms of U.S. money supply? Fed already hinted at ending QT by the summer. All of the central banks globally already started easing. Meanwhile, yes, correct. I agree. I think that's going to happen. I don't have a crystal ball like anybody else in the next 3 months. You get these dot plots and stuff. I don't really bother with them. I just like to look, I honestly do not follow what they say. I just follow what they do. And to me, that's by charting it out. Yes, I don't have they have been cutting. Look, it's always important to say this. Even though they have this Fed repo stuff, which is also cutting, and this is non-commercial bank money. Let's ignore that. Let's take this off. To be clear, this QT, we can even visualize what Venom is saying here. You have, from this point, October 2021, where you have max bank reserves. As far as the banking system goes, they have been tightening. This is the visual representation of rising interest rates for the system. They've been taking those precious reserves away from banks, so banks are forced to look elsewhere for yield. So they went from 4.2 trillion down to 3.3 trillion. And this is the most, as they call it, high-powered money, because it can just exponentially change the picture of the system. That's what I mentioned at the very beginning. This is why this is the most important money supply to look at, in my opinion, because it shows you, how difficult or easy it could be for banks to lend. And the question will be, is it going to be too tight? Because central banks, though they are always erring on the side of caution, which we've seen here since 2008, usually they print too much, right? So we saw the Federal Reserve from 2014. It took 6 years. So when they tell you that the Federal Reserve always prints, it's not true. Yes, they always print the physical cash. Generally, that never changes, right? But this bank reserve portion this is really where you can see it. They tried for 6 years to get the fat out of the system that they bailed out. All that M3 fat that they bailed out here, they tried for 6 years to get it out, and they couldn't do it. They themselves got bailed out with an excuse from COVID to print. They went from 1.6 trillion in reserves to 4.2. Plus, they added some reserves for non-banks. This is basically reserves for non-banks, the repo, but it gets confusing, like I said. So yeah, my answer to your question is, morning, Gio. My answer to your question is, I don't know exactly when. You are absolutely right that all other central banks are starting to print or keeping, even printing more because of uncertainty. Plus, we have the Trump tariffs, which are just wild. China's certainly laughing at us, but China's not in a great position either. They have a lot of liquidity coming. At some point, we're going to get a turnaround just like we got here. All right. And when is that going to exactly come? I don't know, but you'll know. When you see interest rates really fall, when you see Donald Trump saying we need lower interest rates, then you're going to see this rise. And I know this doesn't look like it's rising because it's negative, but that's how I have to show it, because it's, this is what all the other money is levered on at the end of the day. And I have multiples to show that too, like 100x or whatever it is. This is what all the money is levered on. And I think that it's going to increase. Within the next year, probably yes. I'll be very surprised if it didn't. And they already knew that this was harming the competitiveness of the broader money supply. So they've done a lot of cutting. Right, the total, you're getting over 6 trillion. All right, they're now down to, with the Fed repos, 3.9 trillion. And remember that this gray area went right into M3. Okay, so you see M3. As usual, I got to reset the zooms. There you go. I know I already talked about this, but this will cause inflation. This will cause price inflation. Is you're having the liquidity leave the Fed, go into the system, more dollars chasing relatively the same amount of goods and services. Of course, it's all relative. Of course, there's more goods and services every month, every year. It's generally how things work. But you will have price inflation there. And that's already gas on a very, how do I want to say it? Very volatile fire. What I'm mostly looking at, though, as far as the U.S. goes, is, Yael, what's up, buddy? Eurodollar spike. Indeed. I'm mostly at, and like I said, the Eurodollars aren't even on this because I don't have a proxy yet for Eurodollars. But I got the rest of the M3 components in number 3, and what I'm mostly looking at is you have this divergence between M2 and M3. It's a lot of money. It's a lot of money going back into the system. Usually the Federal Reserve is not proactive, they're reactive, so it seems like there could be potentially a crisis. Again, I know it's not my business to try to call these things, and I don't claim to know more than anybody else, but you can clearly see that when you had excess assets, bad assets moving into M3 money and institutions playing around with all this, usually good things didn't happen. And that happened just before the GFC. It's happening again now. But yeah, I do see, particularly just because of the rhetoric, I see that, this sort of tightening of the balance sheet, which they've been doing since 2022, right? You see the balance sheet of the Federal Reserve is tightening. It means it's getting smaller. on both the Fed, on both the bank reserves and the Fed repos. That's that's going to cause more pain for individuals and institutions. And when it causes more pain, then you just turn the printers on and you give them more liquidity, and the money supply goes higher still. When it goes higher still, it's riskier still. These guys talk about it all the time at their Fed meetings and whatever. Like I said, I really don't pay attention too much to what they say. The headlines for sure, but it's more about just looking at what they do. It's pure gasoline on the fire if they start lowering interest rates. I mean, I know they've lowered them a little bit in the last 6 months, but if they, they're still. This also shows, on the margin, they could still lower interest rates and shrink the money supply, because on the margin, that works out okay. The market accepts it. That's what they have been doing over the last 6 months. They've been slightly lowering interest rates. I need to get another chart with active rates showing you versus the money supply, but they have been shrinking rates slightly, and the balance sheet has been slowing. Obviously, nobody likes that. That's not fun. So they're going to want to, at some point, lower them more and then increasing the balance sheet again. Another thing I want to show in the next videos are what the trend line would be for these money supplies pre-GFC. And even with M3, you'd catch this data, but draw trend lines through, say, M3 and the bank reserves, and show where would that line, just a simple regression, where would it be today versus where they are? I think that would be pretty telling too, because as complicated as these guys like to make money sound and monetary policy sound, it's not that complicated. It's just print money, let the market do what it wants. I am as free market as the rest of the people. I believe that banks themselves could do printing of money and figure it out better versus the central bank, but this is the system that we've had for the last 100 years, 110 years. So the most interesting thing to me is just to draw trend lines about the long-term trend and then see where they are relative to that. And then this is an awesome trend line itself, because you just see Bitcoin just keeps. This should give you supreme confidence. Doesn't really matter where money's going. It comes up, comes down, goes up again. And I've tried to make this point a lot. I'm not sure it always comes across. I'll end the video with this one. Yes, they say follow the money. I don't know how you manage to follow them when it's printed at the speed of light. Very true. Every day they're tweaking this stuff. But let me put this back on. This is a good way, I think, to show it. Okay, so just the bank reserves and M0. Let me take again. I gotta reset the chart. My coding skills are not so great to deal with these issues. All right, so I'm going to take off all the broader money supplies. Again, Bitcoin's only comparable to the base money supplies. Let's take off this. All right. Ah, shoot. Got to get on log. And that means I got to put all the things back. All right, log right. There we go. Let's go here. All right. Beautiful. This is a power curve. Obviously, this percentage penetration of U.S. money looks the same as here. I could draw a trend line, but you can clearly see it. It's a gently sloping decrease in the rate of growth, but still extremely strong curve. Notice, to me, the long term, the interesting thing here is, and this is why this orange line should give you such confidence. It's actually not about even the United States money supply. It really isn't. Because as we saw here from 2014, and this is like a period of supreme growth for Bitcoin. Yes, we had the crypto winter after a big boom. But, look at what was happening to the bank reserves. I know this is upside down, but bank reserves are decreasing all through this period, decreasing, less liquidity, less central bank money in the system, and Bitcoin still goes up on that power curve. Yeah, it has its spikes and 4-year peaks and troughs and everything, but money supply is like bottoming out here in 2019, and we even had that little bump. You remember that summer 2019 bump in Bitcoin? It did start to line up here. All right, more money printed. Bitcoin in 2021, I've said this before as well, is you do start to maybe see something match up, and then it goes down. Bitcoin goes down. In my opinion, this is more coincidental because we had a lot of things happening in Bitcoin at this time that had, again, nothing to do with the Federal Reserve. It had all the meme coins, all the nonsense, and then FTX obviously was the biggest one. Celsius, all these jokers. Just scams. It has nothing really to do with the decrease in money supply, but it is lined up. This is true. It is lined up. But then again, look, base money is basically flat. It's flat here. And Bitcoin goes up again. What I'm trying to say is, what you see in the orange line is the power of Bitcoin's adoption more than having really anything to do with the United States liquidity. We are where we are. I can't show you data, back in the 2000s, even though the web was, getting started because we didn't have Bitcoin. We are where we are. I can't for sure guarantee that's the thesis. But I think that the power curve reflects adoption. Price reflects adoption. Adoption reflects the world's interest, right? And it just grows according to power. As I talked about yesterday, these are how networks grow. None of that really has anything to do with liquidity. Liquidity is a part of it, where people get interested in Bitcoin, the 4-year booms, that's a whole thing. But it's like that curve just goes up in that nice slope like this, right, over time. And since 2016, it's been doing that through a lot of ups and downs in the money supply. But it is true to some of your guys' questions, like, we did line up with it in the last cycle, right? A lot of printing. But I think that was coincidental, my opinion, because, we had meme stock trading, we had COVID, we had people locked down, nothing to do but stay on the computer. I think it was coincidental that you had a blast in the money supply and a blast in Bitcoin price. My point is, again, you should be encouraged by looking at this orange line because it's much more solid as a penetration of the money supply than the money supply itself. Like, I got to draw trend lines on this to show it better. Like, there's no way that the Federal Reserve, even though the Federal Reserve is, crazy with their peaks and their troughs here, they're still going to increase the money supply, that's for sure. But Bitcoin grows at a way faster growth rate. Let's just say, for example, it's something like 10%. It's a little bit less. It's like 9%. But, the peaks and the troughs, whatever. The all-time growth rate of the dollar, this is the dollar, this is the base money dollar, is 8 to 9%. Sorry, 9%. As I talked about yesterday, the slope of this curve is 45% per year at the moment. It's decreasing. By the end of next year, the slope of this curve will be 42% per year. But it's a very slow decline. But it's still over 4 times higher, faster than the dollar itself. So that tells me, I hope I'm not reiterating this too much, but that tells me the curve, the adoption is way more powerful than any idea of liquidity or money printing or people protecting their purchasing power. It's just a network. It's an awesome network being adopted. And that's what you see. All right. I got to go, guys. Not feeling great, but other things to do today. So thank you. Thank you guys for watching. Always appreciate it. Let me know if you have any other questions, and I'll try to get that ready for the next video. Have a lot of trust. Wrong word. Don't trust verify, but have a lot of confidence in this orange line because it's going up at a very predictable rate compared to whatever the Federal Reserve is doing. See you guys. Thank you. Thank you, Venom.